Thanks, Douglas, and thank you all for coming today. Nice, cool weather to wander around the streets. There are a couple of items I'll talk about. First, I'll talk briefly about performance, and then I'll take up some of the issues that are probably uppermost on your clients' minds. This last 3 years has been interesting in the markets. We've achieved in the international fund a return just shy of 25% compound. So that's about 187%, I think, over 3 years. It's a little better than the average, but it's disappointing to us because it's not our normal gap against the market. And I'd just like to spend a second or two describing why this is the case. What we are seeing is this remarkable fear trade, that there's huge caution in this highly dysfunctional world. So you're seeing many investors seeking refuge in supposedly secure or safe type of investments. And those tend to be the big brand names and those companies that have had a history of relatively stable earnings growth. There's been a huge concentration in these bets, and there's also been quite a lot of money going into healthcare. The trouble is with many of those companies we're talking about, those big international brands, we observe that in fact their sales are barely growing. And if you look at the problems now besetting the Tesco's, the Woolworths of this world, you can see how the pressure is starting to mount on those companies and their pricing power. So here we have companies that have set up very high umbrellas of pricing, which has allowed own brands to come in, and our view is they are actually more risky than they appear to be. So we, following our normal contrarian approach, have no interest in buying those sort of stocks. And they have been good performers. The second reason for the performance being average rather than good is the very low dispersion in stock returns over this last several years. And the way to think about this, or the way we think about it, is such. Good manager, over time, might pick stocks in the 40th to 45th percentile. In other words, have a relatively small margin of winners against the overall returns from the market. When you have a very narrow dispersion of outcomes, it does reduce the scale of opportunity for stock pickers. And so if you look around the world at stock picking fund managers, you can see a very clear pattern that most of us in that bag have found it harder. So firstly, let me just show you a couple of charts. So this is what I call the fear trade, where the so-called defensives, the yellow line, has clearly outperformed the blue line, which is the cyclicals. And you're seeing it in this market. The cyclicals just struggling. And there's a concern about, in an oversupplied world, particularly in commodities, where is the demand going to come from? But this is the really interesting chart. If you look at the vertical blue lines, that shows you when there's a high dispersion of stock outcomes. And as you can see, from 2000 to 2004, our performance, which is the yellow line, was very strong. And then, sorry, it's not the yellow line, this is a dispersion measure. And you can see how in 2007-8, it started to blow out again, and recently it's been very flat. It's in these conditions we do have greater difficulty. But of course, whether this stays as it has and continues to convey the idea that one should not bother with active managers remains to be seen. Our view is the desire to be in ETFs, etc., is just confluent with this very narrow dispersion. We see no reason why it should persist over time. And lastly, as you know, we tend to have an invested position less than full. So we have managed to match the market with 80% exposure to the market. And included in the 80% is some shorts, which have not been easy to make money out of in a rising market. Anyhow, that's the explanation for our average performance at the moment. Let's just look at these concerns you might have around the world. And they obviously relate to the Australian dollar, the slow and slowing economy in China, the whole Eurozone issue, the US, and valuation. So we'll start with the US because that's quite clearly the locomotive for the moment. And it's evident that this is a very mature bull market here. We're talking about a market that's been going up for 6.5 years. A typical bull market might be 4.5, 5. But there's nothing special about that term because we have different circumstances here. Sorry. So we have different circumstances here. So what's so different? Well, commodity prices are breaking down. You have very low threats of inflation. And with that, you have a very strong dollar, which, of course, is making it difficult for US firms to show earnings progression because the S&P derives about 45% of its earnings from other currencies. So when they convert into US dollars, some of them have diminished returns. So one can paint a picture where you could say the US market is topping out. We don't have a strong view either way. We simply can't find stocks there to the same degree as we can elsewhere. But we can also find rays of light, and in particular, the job market and the property market. And these are very important drivers for economic activity. If you look at the job market, typically at 5.5% unemployment, which is where we are now, you tend to start getting more price flexibility, more ability to raise your price as a provider of labor. It hasn't been showing through yet, but when we look for the interrelationship of data, we can see some good measures, one of which is jobs advertised are growing now quite a lot faster than the job take-up. The days to fill vacancies is equally expanding. It's taking longer to fill vacancies. And most important of all, people have the confidence now to switch jobs. So if you look from 2009 to now, the job switching ratio has speeded up quite a lot. So our suggestion is that there is now a tightness in the labor market. Participation certainly has dropped, we understand that, but there seems to be a tightening, and we could see wages starting to creep up at a faster rate. The other important driver for the economy is housing. In the GFC, we had many people having to forced to sell their places. Housing formation dropped as folk went home to stay with their parents and so on, and it's dropped and has been dropping from about 69% house ownership now to about 63%. And likewise, as I say, household formation has been quite weak. It got down to about 600, which is half the normal rate, 600,000, and it's now well on the way up towards 1.1. So when you look at that, you've had a clearing of the stock of unsold housing. That's now back to slightly below normal. You've had housing formation start to creep up. You've seen starts creeping up strongly. But interestingly, like here, the starts, 38% of those are in multi-dwellings. So that is flat apartment buildings. So there's a change taking place, just as we're seeing here, the type of houses the millenniums wish to live in. And of course, rented accommodations become much tighter. So there used to be about 11% stock of unrented accommodation. That's dropped to now about 6.5 to 7. So when you put all that together, you can see that we're on the cusp of the mortgage rate perhaps going up, but also the use of mortgages starting to increase. And I put a proposition to you. Do you really believe that with those statistics on housing, that an extra 1 or even 1.5% on the mortgage rate, with the threat of it perhaps going higher, will stop people buying houses? Because that's the better discussion to have rather than to fret about whether we're going to see rates going up. Because the contrary position is, if we don't have rates going up, we are going to have pandemonium in markets at some stage, because rates represent the gyro compass of our economic system, whether you like it or not. It's the price of money, the very allocator of the source of our being as free market economies. So I suggest to you that we have to have rates going up. We're already seeing distortions in the use of cash. We're already seeing that now. The longer we leave this, the greater the risks of misallocation become. So that's a question you must ask. Rather than reading the newspapers, ask yourself, will people avoid taking out mortgages because they're costing you a little more? And have the prospect of perhaps costing you a little more still. For the moment, we cannot see inflation. If you look at Europe, we tended to ignore the problems of Greece, because Greece was a bit of a special case. It had a lot of debt, we all know, but they didn't have that industrial base or that tax base which you saw being enforced in Italy, Spain, and Ireland. So in all those countries, you saw the amount taken out of the economy by the government go up as those economies shrunk. At the same time, government services were cut back, wages to government employers were cut. There was huge adjustment across the system, and in places like Ireland and Spain, big reforms to labour. So they were in a slightly different boat to Greece. Not that Greece didn't make a lot of adjustments. So our sense was, whether it stays in or drops out, that won't change the actual position of Europe. But here again, the focus we've been having in Europe was one of looking at their current account surpluses, because these started coming through a year and a half, 2 years ago. The importance of current account surpluses is simply this: it allows you as a country to self-finance your growth. You are devoting such resources to exports and so reducing your own consumption, you become, as a nation, a net saver. That changes your dynamics completely. You are in a completely different position to when you were a net borrower. You can have outstanding debt, but when you're still needing incremental capital from abroad, you really are in deep trouble. So we look at Europe, and our sense is that we had a current account improvement across the board, and it's been impressive. You've seen these reforms. Spain was very early to bring in reforms on labour. It took time, but it's been put in. We're now seeing both political and economic reform in Italy. And you're just seeing the ease of doing business is improving. Now, that's a strange thing to say about Italy, but it nevertheless is starting to happen. And of course, you're seeing all the same hallmarks you saw in the States. The property market has turned. Prices of houses and flats in Dublin are up a lot. Jobs are growing again. Wages are creeping up. And I'll show you a couple of markers here, which are quite interesting. So you look at home price recovery. You look at auto sales. So you can look at the yellow line is Ireland, and the light blue is Italy, and the dotted lines are Spain. So they're all kicking up, hesitantly in some cases. Now, what the governments are also doing is they've tended to hold the line on welfare, and they have started to spend some money on augmenting business investment. And I think that will continue. So our view is that we'll see growth in Europe. It'll be slow, but like the rest of the world, on the increase. Just on a passing matter of the euro, there are two problems that are fundamental. One is not having a common tax base, but the real problem is simply that the productivity of the north of Europe is completely different to that of the south. When you look at Germany, it has a current account surplus that matches that of China. over $250 billion a year. It's extraordinary. And it comes from a huge investment in infrastructure, modernization of industry, huge productivity differentials. And so longer term, we have a problem with Europe, but that's not the issue for the next several years, which is the investment horizon most of us look at. Lastly, let's look at what's happening in Japan. You've heard us on Japan over the years. It is changed. It has changed beyond recognition. The yen has made it incredibly cheap place to do business. We are now getting something like 20 million inward-bound tourists a year. It is a very cheap place to visit. Chinese love it, and the whole world seems to be arriving. When you consider that a place like Paris might get 40 million visitors a year, it's pretty interesting that Japan can receive 20 million a year of visitors and growing very quickly. Jobs are growing, wages are creeping up, management have changed through a generational change. There's a much more worldly view of things. They're starting to use foreign directors on serious boards. And of course, they're starting to take the use of half the population, which is the women within the economy, are starting to get some say in the matters. So we're pretty optimistic about Japan continuing in this bull market. And Japan Fund's been huge, as some of you know, 40% a year for the last couple of years. So overall, our view is that some markets are pretty fully priced. We think Asia, which Andrew will talk about in a second, looks the most prospective. And we continue to run some cover and cash. But if you look at the portfolio, in the international fund, we have 50% in Asia, of which 1/5 is Japan, so 10% of the whole fund. We have about 20% in the US, 20% in Europe. We are short 10%, and we have cash of 10%. We do not own the Australian dollar. We still do not own the yen, but are starting to soften our view on the yen. And indeed, even on the Australian dollar, if we get some stabilization in the growth rate of China, which is possible soon, we could see the Aussie being a little more responsive to an upward bounce. But let me allow Andrew to take you through all of this. Thanks very much.
Good afternoon, everyone. We have to go back to the early 80s when China started to open its economy to market forces, for India, the early 90s. And it was really these very fundamental change in these economies that began sort of this period of extraordinary economic growth across the region. And this is a great picture of what has been achieved in that period. So these photos are across from the Bund to Pudong. So when I first went to Shanghai in the early 90s, Pudong, on the other side of the river there, was essentially still low-lying industrial buildings and rice paddies. And today it's one of the most extraordinary CBD areas you'll find anywhere in the world. But it's not just Shanghai. To give you some quantum of it, in Beijing, since 2000, we have built A-grade office supply 3 times the size of Hong Kong. And you fear that it's all empty? It's not. Vacancy rates are of the order of 5% today in Beijing. Asia has been the part of the world, the region of the world that has grown most quickly over the last 2 decades. And our simple message today is that we think it will continue to be for some time to come. Now, there are various concerns that you might have about that statement, and I will get into some of those a little bit later on. But the other message I want to leave you with is this, and that is that investors globally are not taking this region seriously. It's still being treated as some kind of fringe market that we can play around with when we're feeling bullish about the world. But indeed, as I'll show you, we have some of the largest companies in the world in a very significant market that people are not looking at as they should. But let's just go to why we're confident that this region will continue to grow. So we think of some of the underlying foundations. The financial capital of this region is extraordinary. So we have savings rates in China of over 50%, India of the order of mid-30%. Every country in the region, with the exception of India, where it's fairly a small current account deficit, they are all running current account surpluses and significant current account surpluses. So very simply, the growth in this region is being funded internally. It is not requiring outside help as much of the developed world does in terms of financing their growth. The other thing that it has going for it is its social capital. So in simplest terms, while people today fear that China as growth, the demographics are such that the workforce has peaked in size, which it has, the fact is that the educated workforce continues to grow very strongly. So today, 1/3 of the world's graduates come out of India and China alone, university graduates. But interestingly, even when you look at this a little more closely, typically of the order of 40% of these graduates are coming out of the science, engineering, mathematics faculties, compared with numbers more around the 20% mark or below for the rest of the world. And if you think about where growth opportunities are today, whether that's broadly around information technology, if we want to group all of the internet and what's going on there within that category, or we think about biotech and pharmaceutical, these countries are creating the workforce that is needed for this new era in economic development globally. Of course, one of the initial driving forces in the region's development was simply their low labour costs and the ability to manufacture goods much more cheaply than the rest of the world. Globalisation continues. We now see trade exports globally are up to over 30% of GDP, from below 20% in 1990. And in spite of very significant increases in labour costs in China, today the unit cost of manufacturing in China remains essentially 1/5 of the developed world. And that's before we start talking about places like India and Indonesia, which have significantly lower labour costs, but because of their labour laws make it difficult for the moment to enter into that low-cost manufacturing. So we look at all of these variables and it's very hard to see them going away, but there's also some newer variables that we need to think about. One of the most important occurrences in the last decade for the emerging world has been the internet. So in particular, the internet's impact in the emerging world is somewhat different to our own. For us, we typically had access to information, we had access to goods and services, we had access to payment systems that worked pretty well. But in the emerging world, very often we are getting this for the first time ever. And in particular, it's really only arrived in the last 5 years with the advent of 3G phones and now 4G phones across places like China and India. So if you look at the number of internet connections in China, effectively it has risen 5-fold since around 2009, and we have more than 650 million people with a connection to the internet today. And of course, the other variable, which it's hard to go into great detail, but we can now look at the reforms that are occurring in India and China. Of course, that's been part of the environment the whole way through, but today we have very significant reforms occurring in China around the financial system. There's been positive action to clear up the problems of local government financing. There are reforms coming around the mobility of labour and the efficiency of the state-owned enterprises. In India, we have a new government that is very clearly pushing ahead in getting infrastructure built, as well as improving transparency in that economy. So together, all of these are the variables that we think are in place. We can't see them disappearing, and we really do think that economic growth in this region will continue to be much stronger than the rest of the world. So let's go to some of the concerns that we all will have about investing in Asia. And I'll focus on two of these that are on the slide, and that is, I think when we talk to individuals about investing in Asia, their greatest concern is always about the companies. Aren't they going to steal money from us? Can you trust their accounts? You know, how do you know that they're doing what they say they're doing? And there's a few variables here. I mean, first of all, and I'll keep emphasising this through the rest of the presentation, is how large and significant some of these companies that we're buying into are. So many of these companies, if they started as private enterprises, you can imagine they have pretty good internal controls. If you're, starting a private business anywhere in the world, you tend to want to know where your money is and where it's going and what's happening to it. So if you're a company like Baidu that today started as a small private enterprise 15 odd years ago, and you now have 11 billion in revenue, you're going to have pretty tight controls around what you're doing. Even the government enterprises that are large, that, we're looking at companies that are, multiples the size of many of our own, large companies in this market. You can't be a bank the size of the CBA without knowing what's happening in your business. I'm not saying the controls are going to be as good as they are in the developed world, but they're certainly not non-existent. Interestingly also, we're asked a lot about how we research the companies that we look at. And I can tell you, on face value, it's not very different to what we would do in Australia or the US. We're looking at annual reports. We're talking to broking analysts. We're talking to the companies, their competitors, suppliers, anyone who's got industry knowledge. And the whole research process, wherever we are trying to cross-reference what we're told about the companies we're looking at. We are not simply accepting the PowerPoint presentation of a CFO of the companies that we buy into. Now, I'm not saying it is as straightforward as buying a US company where there's vast amounts of information available to all, but it's not as thin on the ground as you might think in terms of what we have access to. But if you don't believe any of that, and I'm not sure you all will, I'll tell you this. And that is that, as we've thought about this issue of corporate fraud and how it concerns people when it comes to investing in Asia, we've sort of come up with the analogy that it really is a bit like a shark attack. It's not very unpleasant when it happens to you, but it doesn't happen as often as you think, and certainly the media beat it up very significantly. So in 25 plus years of investing in the region, Kerr and I can think of one company out of several hundred that we would have invested in where we think we've lost money because we have been misled, because the accounts were fraudulent and we were stolen from. It's not to say we haven't lost money in many other companies, we have, but to be reasonable, you've got to attribute that to our poor judgment or bad analysis. So really, we just cannot get that concerned about this particular issue. Probably more front of mind, though, is what's happening in China today. The question we still get asked is, well, is China slowing down? Well, I hate to tell you, but it's not a good question because China slowed down. It is stopped growing at 7-8% 3 years ago or earlier. It is growing at, we don't know what rate, we certainly know the GDP stats they put out the other day, 7% are meaningless. So we're not relying on that when we're looking to invest in this country. We certainly know that non-performing loans are going to build up. There's been extraordinary use of credit in this the last 7 or 8 years, and there will be non-performers. So when we see the stated numbers from the banks, they probably are about right, but they are going to grow, and that is not going to surprise us. The other one, though, that gets a lot of press, which we're not quite so fearful of, is the property market, where you get many of these stories that keep coming around about the ghost cities that have been built across China, vast residential developments which are empty. And again, undoubtedly, there are some of these where that's the case. But if we actually stop and look at what is happening in the property market, the residential property market in China, we don't think it is quite as grim as people make it out to be. First of all, if you look at the amount of building that was done in China, at the peak of the market, there were about 12 million apartments built. It was the largest number of apartments built in any one year. Now, that's a lot, but if you were to compare that with Australia adjusted for population, it's about what we're doing now in this country. That might say more about Australia than China, but let's have a look at it another way. Since the private ownership of property began in 1999 in China, we've built about 100 million apartments now. So that is the entire modern housing stock in that country. So it means that there are quite a few 100 million households who are still living in communist-era housing, which I can assure you is probably not that pleasant. Now, it's not that everyone can afford an apartment. There is an affordability issue, but underlying demand for modern housing stock will be there for some time to come. But if we again look at the market, another thing of note is to look at what's happening in the secondary market in property. So in the big cities today, the secondary market where you as an individual owner of a property are selling to an individual buyer is as much as 40% of turnover of all property. So we have millions of apartments freely trading hands in a free market. And the prices they trade hands at are at small discounts to the peak prices reached a year or two ago. So we really can't get ourselves too concerned about property. We don't think it's going to be a great growth area, but undoubtedly construction will continue to be a not insignificant part of this economy. But let's get to the part of the story which we think is actually exciting and why you really want to be and need to be investing in China today. We have, in the coastal cities, vast numbers of households that are now getting to income levels of $8,000 to $10,000 a year. We have wages growing at around 7% in real terms at the moment. The employment market, despite this downturn in construction activity, is still very firm. And when you start to get beyond needing to worry about where your next meal comes from, shelter over your head, what the average person does is they start to spend money on those discretionary items, like travel, like motor vehicles, like going to the movies. And often people talk about how China, is going to have to become a more consumer-oriented economy, and this is something that needs to be orchestrated by the government. To us, that's a completely false idea. What is happening in China, as income levels rise, people are simply spending money on themselves as we would here. So if we look at some of these areas and think about the stock market opportunities that are there for us to take today. Motor vehicles is an interesting one. At 25 million vehicles a year, we've got to a pretty large market, bigger than 50% bigger than the US or Europe. But if we think about motor vehicles in terms of the number of cars on the road, the fleet is still a fraction of the size of, not about 11 or 12% of the US, probably a third of other Asian more developed nations in the region. So we're going to be buying, of the order of 20 million cars, plus or minus however many, for a very long time to come. At the moment, the car fleet is growing at about 13 or 14% a year. So if we come to some of the companies we own, one of them, PICC, it's the leading general insurance company in the country. Half of its business is writing auto insurance. So its underlying market is growing at 14, 15% a year. But that's the less interesting part of their market because there's much more undeveloped insurance markets there. There's crop insurance for farmers. There's healthcare insurance. There's home and contents. These are products that have never been used because you didn't do that when you were scrambling to survive. And now these areas are growing very quickly. As a company, PICC is an interesting business because they actually make underwriting profits across the business that they write. So it's an extraordinarily profitable insurer. To give you a sense of its scale, it's 3 times the size of QBE. in terms of the premium that they write each year. But it has many years of fast growth ahead of it. We think this will, it'll have good years and bad years with an underwriting cycle, but we think it will grow at the order of 15% for some time to come. And what do we have to pay for this business? 11 times earnings today. So fast-growing business, 11 times, we think that's extraordinary buying. And it's one of the bigger holdings in both our international fund and the Asia fund. Elsewhere, we think about travel. Last year, international travel out of China grew at 20%. We met with a company that we own, Tuna, back in May, and Tuna is the Travelocity of China, if you like, although they have already migrated their business through to being an online travel agent. They are the leading booking agent for hotels and flights in China. And you talk to them about whether they see any evidence of their business slowing. Now, their revenues will grow 100% this year because they are just simply taking share off the old line agencies. But if you look at their customer base, the ones who have already been users for 2 or 3 years, what they see is ongoing and strong growth. So someone who was booking 1 holiday a year 3 years ago is booking 2 this year. And that they see that across their user base. E-commerce is obviously another very high-profile one. We had 14 billion express parcel deliveries made last year in China, up from 9 billion the year before. And to give you some size of the context for how big that is, FedEx globally delivered about 7 billion parcels last year. So e-commerce has now moved up to about 10% of retail sales in the country. And, there's, a significant number of investment opportunities, not just around e-commerce, but all of the internet-type businesses that we know in the West. So along with Tuna, we have investments in Baidu, which is the Google of China. It is the dominant search business in China. This year, 11 billion almost in revenues. 5 years ago, just over 1 billion. So it's a growth rate of well over 50% per annum. And you can buy that on a P of 20 times next year's earnings. We own companies like Youku, which is a sort of cross between, in simplest terms, between YouTube and Netflix. It's an advertising-driven business. Sufun, which is the dominant real estate portal, and so on. And many of these businesses, they're all trading at multiples. We do have to talk in terms of multiples of sales here because many of them are not yet profit making, but typically they're very large discounts to the companies of a similar nature in the rest of the world. But to move on, I think, to maybe what is the best story in the region and the easiest story in the region from an economic point of view, India. India is at a much earlier stage in its development. India is a place that simply needs investment in infrastructure and you will get economic activity. So, there's one study a couple of years ago that showed that a village that is connected by a bitumen road to the rest of the country, property values in that village will be 3 times what they are in another village, maybe 10 kilometres away, that doesn't have that connection. That road simply brings you, as a resident of that village, into the modern economy. It allows you to take a job up the road in a factory. It allows you as a farmer to more reliably get your product to the market. And it's not just roads. Mobile phone connectivity does the same for you. As I said before, it's a very important connection, brings you into access to that modern economy, as does electricity. And while 95% of Indians have access to the grid, well, their villages are connected to the grid, typically they're getting 3 or 4 or 5 hours of electricity a day. So if you think even around your home, the lack of ability to use labour-saving devices, it's a pretty significant loss of productivity personally and certainly in an industrial sense as well. In India today, we have a government led by Modi, who clearly understands the need for this investment. He is experienced in Indian politics. He's very clearly getting things happening. So we look at something like road building. Under the old government, it had ground down to about 1 kilometre a day. By the end of this year, we'll be back at 30 kilometres a day based on the contracts that have been let out. So very clearly, we're starting to see some action in India. In terms of the stock market, right at this very moment, I'd say it's probably not quite as interesting as China. That's simply because we've had a massive run-up in the market post-Modi's election. The domestic investors are very enthusiastic about their own stock market. But nevertheless, there is an area that's very out of favour, which relates specifically to these infrastructure areas. And there's a couple of things happening there. One is that interest rates are still very high. Corporates are paying 10, 15% for their money, and inflation's falling very quickly, so they're high real rates. But more to the point is that we've had all sorts of issues around the rollout of infrastructure, whether that's problems getting approvals from the Environmental Department, or is that you've built a new thermal power station, but the coal mine wasn't developed, or the coal mine's developed, but they can't get the coal to you because the train line, there isn't enough capacity on the train line to get it to you. So there are many companies in this area who have very suppressed valuations. A couple of them, National or NTPC, which is the largest producer of electricity in the country. It's a state enterprise. You know, they're very much in this position of having built power stations that they can't operate fully. It's a very interesting business because they are essentially guaranteed 15% returns on equity once those plants are operating. But those returns have been suppressed by the various issues that they're facing. The country has significant need for electricity still, and they will continue to build their asset base over the next 5 and 10 years. So their asset base will increase by more than 50% over the next 5 years. And yet we're buying this company that will through time earn ROEs of 15% plus and continue to invest at that rate at a small premium to book value. Elsewhere, another one of the infrastructure assets we own, which is Adani Ports. Now, Adani are the one very large private port operator in the country. Their Mundra port on the west coast will move more than 100 million tonnes of cargo this year, and it has grown consistently at rates in the 20% for 5 or more years now. They'll be able to continue to expand that. They have access to around 20 kilometres of coastline. They have 16,000 hectares of industrial land associated with this port. And of course, you know, you might say, well, ports are a somewhat dull business, but you have to remember they are competing with the government. They will turn a vessel around in 12 hours rather than 48, and therefore they are able to extract very good rates for the services that they provide. On top of that, they have several other ports, but significantly a new location on the east coast that again will see them grow their business for many, many years to come. So we're buying it on a P of 22, but given the certainty of growth and also given that hidden value in some of the industrial land they've got, we think that's pretty good buying. And then the last thing I want to talk about in terms of the opportunities in the region is that, you know, we really are no longer dealing with there's always this idea that, you know, the Chinese just make cheap things, they just rip everyone's IP off. It is just simply not the case. The region has got many significant companies with great intellectual property. The obvious example is Samsung. Today, Samsung is the leader in tablets, it's the leader in smartphones, but more to the point, it has all the underlying key technologies. Memory, it's starting to take a good position in microprocessors for handheld devices, and it also has, is the leader in screen technologies. This is an extraordinarily deep company. Over the last 5 years, although it is cyclical, its earnings don't go up every single year because of the nature of some of its revenue sources, but its earnings have grown 50% over the last 5 years. You can buy that on around 8 times. It has no debt. It's an extraordinarily one of the great companies of the world, let alone the region. But it's not just Samsung. Companies we don't own, like TSMC in Taiwan, it's one of the world's leading semiconductor companies. Your iPhones that many of you here will have were all put together by Chinese manufacturers like Honhai and Foxconn. And there is no question that we are talking about very sophisticated operations these days and with significant intellectual property. So to just sum up the case for investing in Asia as we see it is clearly, to us, this is going to be the fastest growing region for some time to come. Now, we will always admit that economic growth and stock market performance do not go hand in hand. But at the moment, there are many, many concerns people have around, around China in particular, but also just a general sense of, what are we buying here in terms of the quality of the companies and whatever. And these concerns are giving you the opportunity, they are the imperfections that are giving you the opportunity to buy into this market. The valuations are very attractive. And although indices are not of much interest to us in particular, just to emphasise how this opportunity is being passed up by the global investment community, I'd make the following point. If you take all of the universe of Chinese stocks, A shares, H shares, NASDAQ listings, they account for around 13% of global market capitalisation today. Now, given the valuation, given the growth rates and the fact that over the next 5 years there will be many, many more companies coming to market, I expect that number only to rise. And of course, that's just China, that's not including the rest of the region. You look at the global indices and Asia is typically 1 or 2%. So it's very simply this, it is a large opportunity, stocks are cheap, but we're all ignoring it because of the fears we have, which we think are misplaced and somewhat out of date.